Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. So much news to cover. I'm going to compact it in a small package. So basically, technology finally cracked. High tech stocks finally cracked. And yet, it's not time to be bearish yet because market breadth held in there and held at critical support. All right. So why did technology crack? Well, there's a lot of pressure because we have companies like Intel and Google emphasizing that they are ready to keep spending to keep up with the AI race. And that promise of increased capex and lower free cash flow percolated throughout all the big cap tech stocks, except for one big exception. Yep, you got it. Apple. Apple soared, almost got back to its all-time high. But again, because market breadth overall stayed and hung in there, this is not a time that I'm going to be getting bearish, but I'm as wary as can be. Now, we have a lot of other pressures that the market is under. So, for instance, the war in Iran has been expanding and accelerating. Just today, we heard that Kuwait and Bahrain launched secret, I don't know what they mean by secret, strikes against Iran. So that is an escalation and a broadening of the war fronts, essentially. And on top of that, oil in response has been creeping up. In fact, this past week, oil accelerated higher, and that's bringing up the specter of inflation all over again. Not just inflation and energy prices, but the kind of inflation that goes from energy to other goods. And as I talked about the escalation and broadening of the war, we have the Houthis also making things difficult for shipping for Saudi Arabia. And you can imagine the increased inflationary pressures, the increased geopolitical pressures that this creates. So overall, lots of pressures on the market, but you probably wouldn't guess unless you were looking at all the specific pressure points around in the market. Then we had bond yields responding to higher oil prices and soaring for a brief moment there. We had the 30-year bond yield went up well above 5%. So that's putting pressure on interest rate sensitive stocks. Overall, the stock market didn't seem to care that much about the higher rates, but this is all now funneling into the Fed meeting that's coming up next Wednesday. And this will be yet another one of those critical, highly watched meetings. As I mentioned in the last Fed, after the last Fed meeting, I was not impressed by the new chair, Kevin Warsh's hawkish rhetoric. I think it's just jawboning. And I believe, this is just my opinion, he has zero intent on raising rates, or at least he's going to try to keep the Fed from raising rates. Remember, he came to the Fed specifically with a mandate to cut rates. The last thing he wants to do is raise rates. And fortunately for him, the bond yields that are rallying and going higher might actually get him off the hook, and he might be able to point to higher bond yields as a reason why the Fed does not need to hike. And in fact, Fed hike could exacerbate higher bond yields. I expect that's the kind of argument that might be put in place. And then if all of that wasn't enough, we had tariff news again. Fortunately, tariffs have not gone up and above prior levels, but they have been extended from the ones that were expiring today, Friday. So tariffs will be an ongoing price pressure. I think because we've lapsed the initiation of tariffs last year, we don't have an additional inflationary pressure. We just have ongoing price pressure. I think under normal circumstances, with all the other pressure points in the financial markets, a government might decide to put those tariffs on hold to provide relief to the folks suffering from all these other pressure points, but that's not the world we live in. Anyway, overall, again, the theme is technology, high tech, cracked under lots of pressure, and yet market breadth is hanging in there, has held in there. So it's not time to be bearish, even though we're creeping ever so precariously close to that bearish edge. All right, let's take a look at the market news in chart. This is my favorite technical indicator, the percentage stocks trading above their 50-day moving averages, what I like to call AT54 above the 50. Very quickly, very easily, you can see that although market breadth has been trending down for much of July, this critical threshold that's been holding ever since the breakout in April is hanging in there as support. And in fact, by zooming here, you can see at its lows on Thursday, AT50 bounce right off of that support. It's very rare, at least in my experience, to see market breadth respecting anything but like overbought at 70% as resistance and oversold at 20% as support. But this is an interesting development, and it's maintaining a neutral interpretation of the market as a whole for me. Now, the percentage stocks trading above their 200-day moving averages did breach briefly this what I just called a pivot line at around 56. Closed at 55.8%. And actually, sorry, let me go back to AT50 really quickly. AT50 closed the week at 52.9%. AT200 at 55.8% is essentially right at this pivot point. So I'm not worried about that either. It also is saying neutral for the market. Let's go ahead into the indices because this is where things get really interesting and kind of dicey. The S&P 500, I don't know whether this 7,500 wall is now becoming a 7,500 pivot. That's kind of what it looks like. Let me zoom in here for you. But notice that it did confirm a 50-day moving average breakdown on Thursday's loss. And with that, let's see, Thursday's loss was 1.2%, but it's still far above the lows, say, from June over here. So remember, that was a close enough test of 50-day moving average support, and the S&P 500 hasn't been lower since. So until or unless that level breaks, I don't really want to get bearish on the S&P 500, particularly with the backdrop of market breadth hanging in there. Now, here's the big breakdown. This is where things get dicey. This is the NASDAQ, and the NASDAQ fell back below its downtrend on Thursday, and Thursday's, this was a 2.2% loss and had very strong follow through with a 0.6% loss on Friday. Now the NASDAQ has closed at a level last seen back here at the beginning of May. And that puts, guess what? It puts in play not just 200-day moving average support, which is that blue line, but also this double top at former all-time highs. The double top happened last year. Sorry, it stretched from last fall or winter into early this year. So that is going to be a very critical support line. In fact, I'm pretty much assuming that this is the track that technology is on, particularly with the momentum, both technical and fundamental, that's going on. So this is something to watch. Now, in the meantime, I went ahead and did the triple Qs. So the triple Qs, just as looks similar to the NASDAQ, because buyers tend to jump into these extreme day-to-day moments. I went ahead and speculated that we'll get a bounce on Monday. It may not happen, but I decided to go ahead and speculate on it. Just got a call spread on the QQQs. And then I also speculated one more time on IWM, the ETF of small caps. It unfortunately is starting to extend the downtrend, but it did hang in there at 50-day moving average support. Let me just show you where that is. So on Thursday, it stopped just below 50-day moving average support, and today it faded. It was hot, it was up for a moment, and then it faded and closed right on 50-day moving average support, which is that red line. Don't tell me technicals don't matter, okay? We see it all the time, all over the place, even on indices, which are huge collections of stocks. All right, let's take a look at the VIX. The VIX is holding its own support. And that's this pivot line. This is the pivot line around what's currently, the pivot line is around 17 for the VIX. That's the pre-tariff low, meaning the pre-tariff low from last year. And you can see now it is starting to hold that as support all week. It either stopped short or it bounced off of that line. So the VIX looks like it's winding up and it's ready to rip higher. But remember, what our experience has been, as long as this is a bull market, those rips higher are buying signals. They're not times to run. All right, let's take a look at a proxy for oil. That's USO, the United States Oil Fund. You could see here that for all of, well, actually, I mean, oil essentially, since it hit a low in June, it's pretty much been going straight up. Let me just show this arrow. And this rally is essentially accelerated along the upper Bollinger Band. On Thursday, because it was so far above the upper Bollinger Band, I went ahead and did I faded USO, but I did it kind of hedged. Basically I faded. I didn't even hedge it. I sold a October call spread that's higher. I think it was 150 to 160, and I used those proceeds to mostly pay for a put spread. I believe, don't quote me on this. I think I did it at 125 to 135, or maybe it was 120 to 130. Sorry, I didn't put that in my notes, but I will be writing more specifically about that in the blog, which, by the way, is at drduru.com/122, all letters /blog. All right, so that's USO. This shows you the pressure. Now, why did I fade USO? Because as my trading trading rules, trading behavior, my trading psychology, I like to move against extreme positioning, and that's what's happening with oil. And you could see the fade did start at the intraday high on Thursday. I talked earlier about rising bond yields. This is going to be putting pressure. Actually, stocks are hanging in there pretty well. This is TLT, the iShares 20 plus year Treasury bond ETF. It's essentially a proxy for long-term yields. And let me just pull it back here. You could see that overall, TLT has been trending downward. And I have been trying to play for a big bounce, bigger than the one we had last month in June. But all that's happening is TLT is being slowly pressured downwards. In fact, this is an important picture to keep in mind, right? Because it means that the bond market is getting serious about the need for higher yields, even though stocks are mostly ignoring that. Although I think these higher yields are starting to pressure high technology stocks, especially given all of the financing that has to happen for the AI build out. Semiconductors, which of course has now become a very significant narrative within tech, has broken down. It's still in bearish territory below the 50-day moving average. Again, that's that red line. It's well below its downtrend line. And with Friday's 3.3% drop, even though it's not a new low for the month or new low for this cycle, this downtrend, it looks poised to continue lower at some point. And I think I talked about last time how I hedged with a put spread. Unfortunately, my execution was very poor. I just wasn't ready to take profits on Friday. And on last Friday. And that just kind of unraveled on me for the rest of the way for the week. And I just barely salvaged some value with today's drop. Very bad execution on my part, but it happens. All right, let's take a look at some big cap tech stocks. Google, let's go ahead and take a look at Alphabet, ticker symbol GOOG. It's in bearish territory. Very simple story here. It's broken down below its 200-day moving average is the blue line. The thing that I think the headline that investors weren't happy about is that the company increases capex guidance. You can see that here by about 15 billion on the low end. 15 billion. So it increased to 15 billion. And that's significant. I mean, it's kind of a drop in the bucket overall for a $1 trillion plus company. But anyway, I think what investors are seeing is this constant increase and no end in sight in the increase of the capex spending. So now Google is in bearish territory. Not good. I really thought it was going to just continue this rally, and unfortunately, that looks stalled out. And Meta fell in sympathy, actually. Meta, this is Meta Platforms, ticker symbol META, fell in sympathy with Google's post-earnings drop. It fell 3.4%. Now, again, I have to remind you that Meta is just bouncing around all over the place. It's been a trading range. It hasn't gone anywhere essentially since 2024. So I don't want to overplay any of these particular moves, but just know that this big excitement that happened earlier in the month of July has now completely faded away. And what caused all the excitement was a bunch of AI news and new platforms and software and whatnot. Tesla was a big surprise to me. This is ticker symbol TSLA. I am used to basically investors not caring whatever Tesla reports for earnings because they're too busy looking out 5 to 10 years when all these robo taxis have taken over all the roads across the planet and robots are in every home. But this time, investors did seem to care. Tesla dropped, what was this? This was 14.5% post earnings and strong follow through selling at 2.1%. Let me just make it clear here. You can see the massive volume also that accompanied the selling. Big time volume here, decent volume on the follow through. But anyway, very bearish times for Tesla. And what Thursday allowed me to do was to finally take some profits on a TSLQ position I had. But then I went right back to my typical thing of assuming that buyers step in when Tesla moves extremely down. But Friday is making me a little concerned that Tesla may not have much of a bounce next week, but we will see. What I did is I did a very aggressive calendar call spread. It was a diagonal. So the short side has already expired. So it helped pay for the long exposure that I want to play out for the week. But overall, net, because of Friday's strong follow through to the downside, it is in the red. Let's go back to semiconductors. I forgot to go through these after showing SMH. Intel Corporation, I know I talked so much about Intel, ticker symbol INTC. I think now Intel has been topping out. Again, remember, Intel's a very expensive semiconductor stock now because of its huge gains this year. But what I've been counting on is all this positive news flow. You see all of these green boxes that I draw. And let me actually remind you from last year too, is that this positive news flow has been pumping Intel up and up and up and up and up. If Intel doesn't continue to get new news, it's going to fall and deflate. That's just the sad part of this. And the technicals now are pressuring Intel. What I told a friend of mine is that Intel now is in free fall territory. It faded. I mean, I think it was up as much as 5% post earnings on Thursday night. And then it actually opened flat. And that was already the warning sign. If you're a short-term trader, that was a warning sign that a fade is in effect. And sure, Intel made a tepid, actually, let me zoom in here so you can see, made a tepid move to the upside, just barely, and then sellers took over from there. Intel lost 7.9% on the day. It closed at a new low for this cycle. And in fact, it hasn't closed this low since late April. So very bearish for Intel. It has started, I didn't draw a downtrend line in, but essentially it's time to assume that Intel has topped out and a downtrend is underway. And what I mean by free fall is not that it's going to completely collapse, but that you see this uninterrupted run up. Actually, let me just draw an arrow in here for you. When you're in the middle of this and you're riding it higher, these uninterrupted run-ups are fantastic. You make lots of money. But the problem is eventually these things exhaust themselves. There are no more buyers. And when that exhaustion comes into play, a stock can just completely come down, take the elevator up, as they say, and take the escalator down. And there's very little natural support on the way down. I did draw in this former all-time high from September 2000. I'm going to assume that that's going to hold on any additional selling. If not, then there's the 200-day moving average here, which is the blue line. Another, of course, important semiconductor stock, we're talking about the memory sector, Micron being one of those banner stocks. Micron is turning down. It wasn't a downtrend, it broke out, but on Friday, it lost 7%, and it's below its 50-day moving average. It looks like it has basically lost. Obviously it's a huge gainer, but I think it's going to be very hard for it to mount a rally. For these kinds of stocks, I'm going to assume that they're just going to keep chopping around and fooling bears on the one hand and bulls on the other hand. And that's just the way it goes. All right, let's keep it moving. Cerebras. Cerebras. I think it's Cerebras. I always forget. Sorry about that. Uh, so this was an interesting one. I finally was able to get out at a profit. I'm gonna have to actually. I'll just write about this in the blog. It's easier to describe there. But I was able to get out at a profit. I missed getting out on this big run up here on Wednesday, and here's the news. Got detached here a little bit. First, there was the CrowdStrike strategic partnership, but then it faded hard, and I didn't get a chance to take profits there, so that I wouldn't miss out. I put in a limit order, and sure enough, it got taken out the next day. As actually, there wasn't new news, but the stock did soar, and then it faded again. So it looks like it's topping out for this, but I think ticker symbol CBRS is just going to chop around. I went in and dared and bought right back in. I know I couldn't help myself. And I'm just going to play a bounce off of this 20-day moving average support. Let's just show where that is. It's the dash line. And maybe it can rally up to these levels, maybe the upper Bollinger Band, where I will seek to take profits again. All right, so that's the last of the AI plays I think that I have. Let's go on to ServiceNow, which was a disappointment. Ticker symbol NOW. The CEO once again couldn't have been more bullish about the company. The stock was actually up pretty decently, about 5%. In the after hours, it reversed Wednesday's. It at one point reversed Wednesday's loss, but then the faders just grabbed a hold of the stock really hard. 3.7% net post earnings loss. And today it rebounded 7.4%, which was nice, but too late for me because I did a pre-earnings play. I do have shares, so of course I'm going to be welcoming any gains, but my pre-earnings play did not work out at all. The AI panic, the SaaS apocalypse, as I like to call it, is in full effect there. Twilio, ticker symbol TWLO, topping out, purple line, confirmed 50-day moving average breakdown. It is in bearish territory. Will be further confirmed if it breaks a low, which would be around. Oh wow, look at that! It perfectly bounced off of that low from June. So that was an important day combination here, Thursday and Friday. But I think this is pretty feeble. And Twilio, ticker symbol TWLO, looks topped out now, but it did pretty good to fight against the AI panic in software. I was really hopeful for Rapid7, ticker symbol RPD. It's a cybersecurity software company that's just had a terrible time since peaking out in 2021. And it broke back down. It broke out about 200-day moving average. This is why technicals can really help. I was waiting and waiting to see if it could hold the 200-day moving average support, but it sliced right through. So I took the stock off my buy list. And sure enough, RPD has continued to sell. I think the story may be flipping back to, even if the stock has bottomed out, which is what my assumption was. In fact, let's just draw a rectangle here to make this bottoming clear. So, when it broke out of this rectangle, I assumed that this was a bottom confirmed. Now you can see that ticker symbol RPD, is about to test that critical breakout point. So I'm going to keep watching, but I am not optimistic for this stock. Reddit, ticker symbol RDDT, had a lot of churn this week. It cracked 8.3%. And I had previously bought it as a play, as a confirmed bounce off of the 50-day moving average, which was right here. It was very nice. And then when it bounced above the 200-day moving average, I thought the rebound was on and would be sustained. It was not, because investors didn't like to hear that media publishers, including Reddit, are considering cutting off their content for AI use, particularly because they are seeing lower traffic thanks to things like Google's AI summaries. Now, this is ironic, right? Because if Reddit and other publishers don't do anything, investors aren't going to be happy either with the drop in traffic and drop in advertising revenues. So it's kind of like these web publishers are stuck between a rock and a hard place. Ultimately, I would like them to see some sort of scheme developed so that they can be properly compensated for their content. And of course, I'm a web publisher too. I barely make pennies off of my content, but I still sympathize with the web publisher side of this economic and commercial battle. All right, let's go to some industrial stocks. ATI Incorporated, specialty metals company. As I wrote about before, I wanted to play a bounce off of the 50-day moving average. It got to the 50-day moving average. I bought, and so far, so good. So, that's a very simple technical story. The charts say it all. Lockheed Martin, ticker symbol LMT. I wrote about this earlier about how it was holding on because the stock was kept bumping into resistance and resistant holding here at the 200-day moving average. Let me just pull out my handy big arrow. So, here it broke down here. It held resistance held here, resistance held here, a little sloppy, and it held here. But I thought, you know what? I don't want to extend my luck any further. I covered my small amount of shares somewhere in here, and it was very timely. I did not want to hold it through earnings because I had no fundamental viewpoint. That was strictly technicals. And sure enough, Lockheed Martin broke out above its 200-day moving average, 10.5% post-earnings gain. And now, guess what? Lockheed Martin looks much more bullish and looks better, even though there's a lot of large chop in the previous years. But anyway, it's broken out. It's looking much better. A stock that looks a lot worse is Intuitive Surgical, ticker symbol ISRG. I tried to give this stock, I think I've given it 3 chances now in the recent year or two. I finally have given up. 14% post-earnings drop here. I went in and took my lumps, and the stock has continued to slide down. This stock is not acting well at all. It looks like, this top is held. I drew this earlier. This is a double top. It looks very clear that the stock is rounding out and is about to go through a who knows how long phase of just going nowhere. I don't want to short it because I am a fan of the company and its technology, but I do not think it's investable for me at these levels and with this kind of behavior. Speaking of not being investable, Robert Half Incorporated, ticker symbol RHI, they do staffing. This is, they've been suffering for quite some time since peaking out 2021. Looked like they had finally rounded the corner here, but right before they reported earnings, the stock plunged on high volume, 7%. And today on Friday, it plunged another 6.7% post earnings. So this stock may have topped out. It's still in a bullish position because it's broken out above 200-day moving average, 50-day moving average, but I don't trust these kind of moves. It looks like, well, let's see what happens. If it tests support, maybe there'll be a case for buying in. Retail stocks were all back into focus for me, given oil has been going up, even though I suspect oil may be topping out again soon. A lot of parties have interest in keeping oil prices capped where they are and sending them back down. I cannot resist looking for opportunities to buy Abercrombie and Fitch Company, ticker symbol ANF. I think it's holding up pretty well here on 200-day moving average support. Again, the blue line. I bought right around in here, so far so good. But it is It is very choppy. So this is a story left to be told. I will hold this one through earnings unless it has a technical breakdown ahead of that. And finally, let's round it out. The biggest, one of the worst consumer-facing stocks on my radar this week, Albertsons Companies. This grocer got hammered. 21.6% post-earnings loss on Thursday. Sellers couldn't wait to keep up the pressure. 3.6% loss today, Friday. As you can see here, volume, huge amounts of volume. So basically a lot of panic getting out of the stock. And why is that? Well, it's because they are facing margin pressures. So they're facing cost pressures. And instead of passing those costs along to customers, they have decided that they are going to eat those costs and suffer the lower margins. What does that mean? It means that Albertsons is now at an all-time low. Now, I think this is a panic move, and that high volume makes me interested in buying, but I need to see some constructive behavior. What would constructive behavior be? First of all, let me just show it again. I need to see a strong move higher off of the lows, right? So here's the all-time low, and I need a strong close above that to get constructive again. But the bottom won't really be confirmed until the stock can close above its post-earnings its post-earnings open. All right, so tech, just as a quick summary, tech broke and cracked under all the pressures that it was facing. Let's put the NASDAQ up here, but market breadth held up at support, so I'm not getting bearish. I'm very wary, but I did downgrade from cautiously bullish to neutral on the market, and I'll be, again, writing that out on the blog. If you like this content, please subscribe to the channel. Comments and feedback below. Always happy to answer questions. And as always, please like and share this content so the algorithm knows what's up and I can be encouraged to keep publishing. All right. Thanks a lot, everyone. Be safe this weekend. I know there's a big crush of news. And remember, the coming up Fed meeting could be market moving. So stay alert. And we are still, remember, we're still in the middle of earnings week, and we have some big cap tech stocks to come. Amazon, Apple. See, Netflix has already gone through, and I'm forgetting one. Sorry about that. But anyway, you know what I mean. Stay on your toes. Plenty of market moving earnings reports to come. Take it easy.